Stop everything you're doing right now. It's January 16th, 2026, and you need to understand what just happened in the silver market in the last few hours. While you were sleeping, while most of America was still in bed, billions of dollars changed hands in what I can only describe as one of the most violent liquidity hunts I have witnessed in my 12 years of trading precious metals. This wasn't just another dip. This wasn't normal volatility. What we're seeing right now is the exact mechanism that separates professional traders from retail victims. And if you don't understand what's happening over the next few hours, you're going to be on the wrong side of what could be the biggest move in silver this entire year. Let me paint the picture of what went down. In the early morning hours, just before the London session really heated up and well before New York opened, silver was trading comfortably near the high end of its recent range. The tape looked clean, volume was average, nothing felt out of the ordinary. Then, suddenly, the market was hit with an aggressive wave of selling that looked on the surface like pure panic. In less than 20 minutes, silver was driven sharply lower, wiping out nearly 2% of its value in the time it takes to make a cup of coffee. To most people watching a chart, it looked like fear. It looked like something broke. It looked like the start of a larger sell-off. But that interpretation is exactly why most retail traders lose money. That move wasn't panic. It wasn't emotion. It wasn't driven by new fundamental information. It was a surgical strike. It was a textbook liquidity hunt. The largest players in the market, bullion banks, institutional desks, and algorithmic funds, deliberately pushed price into a zone where they knew massive stop-loss orders were sitting. Those stops belonged to retail traders who thought they were being prudent by placing protective exits just below obvious technical levels. They belonged to hedge funds running systematic strategies with predefined risk thresholds. They even belonged to smaller institutions whose risk management systems automatically liquidate positions when certain price levels are breached. When price hit that level, all of those stop losses instantly became market sell orders. Billions of dollars worth of silver exposure was forcefully dumped into the market in a very short window of time. And who do you think was on the other side of those trades? The same players who engineered the drop. This is how the game works. Markets are not gentle. They are not fair. They are jungles. And if you don't understand that you are swimming with sharks, you eventually become food. Before you think this is just an emotional rant, let's break down the actual mechanism, because this is critical to understand. Liquidity in markets works exactly like fuel in a car. You can have the most powerful engine ever built, but without fuel, it doesn't go anywhere. The same is true for price. Large institutions cannot simply push silver higher whenever they want. To move price in a sustained way, they need liquidity. They need sellers willing or forced to hand over their positions. And the easiest source of that liquidity is the stop-loss orders of traders who are positioned on the wrong side at the wrong time. The players who dominate this market have access to information most participants will never see. They understand order flow. They know where large clusters of stops are sitting. They can see the market structure in a way that similar to playing poker while being able to see everyone else, cards. So what do? They wait for the thinnest part of the trading day. Low volume, few participants, no New York desks fully online yet. Then they execute coordinated sell programs designed not to reflect genuine selling pressure, but to push price directly into known pools of liquidity. Once price reaches that level, the stops start firing. Those stops create more selling. That selling pushes price lower, which triggers more stops. The process feeds on itself, a self-reinforcing cascade that looks chaotic, emotional, and frightening to anyone watching from the outside. But behind the scenes, it's highly organized. Every ounce that panicked traders are dumping is being absorbed by stronger hands. This is accumulation disguised as distribution, strength disguised as weakness, and it is one of the most important concepts you can understand if you want to survive and thrive in this market. Now here's where it gets especially interesting, and this is where you need to pay very close attention. After the initial flush, silver didn't collapse. It didn't continue cascading lower. Instead, it began to grind sideways, stabilizing above the lows, but failing to reclaim the previous highs. That behavior tells us something extremely important. Right now, the dominant players are deciding whether they've already gathered enough liquidity to launch price higher, or whether they need to make one more push lower to sweep an even larger pool of stops. There is another major level just below the recent lows where a second, even larger cluster of stop-loss orders is likely sitting. These belong to traders who bought silver earlier, believing they caught a great entry, and placed their stops just under what they saw as a logical support zone. Swing traders, momentum traders, short-term investors who all chose similar, safe levels. From a professional perspective, that zone represents fuel. So the question the market is answering right now is simple. Did the banks fill the tank already, or do they need one more trip to the gas station? Here's how we'll know. If silver can reclaim its prior resistance and hold it as New York comes online, that's a strong signal that the liquidity sweep was sufficient. In that case, the path of least resistance shifts higher. and a violent reversal becomes likely. If, on the other hand, price continues to grind or slips back below the recent lows, then you should mentally prepare for one more downside probe. That would not be a sign of weakness. It would be the final stage of accumulation. And this is where most people get it wrong. Both scenarios are bullish. Let me say that again, because it's counterintuitive and incredibly important. Whether silver launches higher from here or dips once more before reversing, both outcomes support a higher price thesis. The difference is emotional, not structural. If price rips higher, the move has already begun. If price dips lower first, it creates what will later look like a gift entry for anyone who understands what is actually happening. To make this clear, let me give you a historical example. In 2020, gold had just made new all-time highs. Sentiment was extremely bullish. Then, in a single overnight session, gold was slammed sharply lower. Retail traders panicked. Financial media called it a correction. Stops were triggered en masse. Confidence evaporated. Within weeks, gold was making new highs again. That drop wasn't the start of a bear market. It was a liquidity sweep. It was accumulation. And the exact same pattern is unfolding in silver right now. The reason I'm confident isn't because I'm guessing. It's because I've seen this movie before, over and over again. The script rarely changes. Only the actors and the price levels do. And this timing matters even more because today is not just any trading day. Today is the third Friday of the month, which means monthly options. Expiration. This is consistently one of the most volatile days for silver and gold. Billions of dollars in derivative contracts settle today. Calls and puts across multiple strike prices all expire. And to where price closes determines who gets paid and who walks away with nothing. Market makers, the institutions that sold those options, have a massive incentive to pin price at levels that cause maximum pain for option buyers. If too many call options sit above a certain price, there's tremendous motivation to keep silver below that level until expiration passes. This isn't illegal manipulation. This is how derivative markets function. The players with the most capital and the best information exert enormous influence on short-term price, especially on expiration day. But here's the part that matters most. Short-term games cannot override long-term fundamentals. Silver has been in a structural bull market for over a year. Prices are dramatically higher than the lows. Industrial demand is surging. Supply deficits are real and growing. Governments and central banks are diversifying away from traditional reserve currencies. Inflationary pressures, geopolitical instability, and currency debasement all support higher precious metal prices. The banks can hunt stops for a day. They can pin price for an expiration. They can scare weak hands out of positions. What they cannot do is change the math. Silver is going higher. Not maybe, not eventually. Higher. The only open question is the path it takes to get there. And when we look back on this moment weeks from now, this entire episode is likely to be remembered as an opportunity, not a warning. That brings me to one of the most important concepts you will ever learn as a trader. You must learn to enter the market when others are being forced out. You must learn to buy where others are stopping out. You must learn to think in terms of liquidity, not emotion. This goes against every instinct you have as a human being. When price drops violently, your brain screams danger. Fear kicks in. Panic sets in. You want to escape the pain. You want certainty. That instinct is exactly what markets exploit. Professional traders are trained to do the opposite. They look for moments of forced selling. They look for areas where losses are being realized involuntarily. That's where opportunity lives. The silver market just showed you, in real time, how that process works. The only question now is whether you learn from it, or whether the next move catches you on the wrong side. Because one thing is certain, this was not the end of the move, it was the setup. In the markets, that instinct to flee from fear will destroy you. The moments of maximum panic, the moments when it feels like the sky is falling, are precisely the moments when the largest players are quietly accumulating. Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." But most people treat that as a clever quote rather than a practical strategy. They admire it intellectually, but they don't live it. They can't. Because when fear is coursing through your body, when you see your position down 5 or 10%, when the financial media starts using words like correction and pullback, it takes extraordinary discipline to do the exact opposite of what your instincts demand. But that is the game. That is the edge. That is how you separate yourself from the herd. You have to train yourself to see a sudden drop toward the high 80s and think opportunity. You have to watch stop losses getting triggered and think that is exactly where I want to be buying. You have to see panic spreading and recognize that this is the moment when wealth is being transferred from weak hands to strong hands. I've built my entire trading career around this principle. Every violent move against the crowd, every stop hunt, every liquidation cascade, I'm not reacting emotionally. I'm studying where the smart money is accumulating. Right now, with silver trading around the upper 80s and the possibility of one final dip into the mid 80s, this is precisely the kind of setup I live for. These are the moments where you can establish positions that later turn into 30, 50, even 100% gains, while the people who sold in panic sit on the sidelines replaying the moment they gave their position away. Let me walk you through the specific game plan I'm using today. This is not financial advice. It is simply how I am navigating this market based on over a decade of experience and a deep understanding of market structure. First, I am watching the $89 level very closely. If silver can reclaim that area and hold it convincingly, especially if it happens before New York fully opens, that's a strong bullish signal. It tells me the liquidity gathered on the downside was sufficient and the market is ready to rotate higher. In that scenario, I would expect silver to push into the low 90s relatively quickly. Second, if price continues to chop sideways or drifts lower and breaks back below the recent lows, then my focus shifts to the mid-80s. A brief flush into that zone, especially one that happens quickly and fails to follow through lower, would be an ideal setup. If silver tags those levels and snaps back, that would strongly suggest the final liquidity sweep is complete. In that case, I want to be aggressive on the buy side, not recklessly all in, but with enough size to matter. Third, I'm deliberately ignoring the noise. I'm not paying attention to what CNBC is saying. I'm not reacting to social media traders screaming that silver is crashing. I am tuning out the permanent bulls who think every dip is manipulation and the permanent bears who think every rally is a trap. I am focused on three things only: price action, volume, and market structure. Everything else is distraction. Fourth, I'm prepared for extreme volatility around options expiration. This is when the most chaotic price behavior tends to occur. Expect sharp moves, false breakouts, and violent reversals. This is the kind of volatility that tempts traders to abandon their plan. But if you can remain calm and objective, that chaos often creates the best opportunities. Now let's zoom out, because this isn't just about one trading day. This is about understanding where we are in the broader silver market cycle and what that implies for the months ahead. Silver had an extraordinary year recently, rising more than 140% from its lows to its peak. Yet, despite that performance, most people are completely unaware it even happened. Ask the average person what they know about silver, and you'll get blank stares. That tells you something important. We are still in the stealth phase of this bull market. The institutions know what's happening. The smart money knows. The analysts who study commodities, energy transitions, and monetary systems know. But the general public remains focused elsewhere, on tech stocks, crypto headlines, and whatever narrative dominates the news cycle that week. That's ideal, because the biggest gains in any bull market happen before the crowd arrives. Think about Bitcoin years ago. The move from obscurity to mainstream awareness delivered massive returns to early participants. By the time everyone was talking about it, the easy money had already been made. The same pattern played out in tech stocks during the dot-com era and in gold during its long bull run in the 2000s. Silver is following that same script. That gives us time, but it also demands courage. You have to be willing to buy when it feels uncomfortable, when prices are falling and headlines are negative. By the time it feels safe, the opportunity is usually gone. The supply-demand fundamentals only reinforce this view. The world has been running a silver deficit for years. Consumption continues to exceed production, forcing inventories to be drawn down. Those inventories are not infinite. Every year of deficit shrinks the buffer further. At the same time, demand is accelerating. Solar energy deployment is exploding, and silver is a critical input in photovoltaic panels. Electric vehicles use significantly more silver than traditional vehicles. The rollout of advanced telecommunications, infrastructure, medical technology, water purification systems, and semiconductor manufacturing all require silver. There is no easy substitute. On the supply side, new production is constrained. Decades of artificially low prices discouraged investment in primary silver mines. Most silver today is produced as a byproduct of other mining operations. Even at today's prices, it takes many years to bring new mines online. This means supply cannot respond quickly to rising demand. This is a textbook setup. Demand rising, supply constrained, inventories shrinking, price still not fully reflecting reality. Eventually the market adjusts. And when it does, the move is not subtle. A common concern people raise is manipulation. Yes, precious metals markets have been manipulated. That is a documented fact. There have been fines, lawsuits, and admissions. But manipulation does not mean price is permanently capped. It means moves are more violent, more engineered, and more emotionally taxing than they would be in a perfectly free market. Banks can suppress rallies temporarily. They can trigger sell-offs to hunt stops. They can create illusions of weakness. What they cannot do is print more silver or eliminate real industrial demand. Fundamentals always win in the end. What manipulation actually does is build pressure. It compresses price action like a spring. And when that spring finally releases, the move is explosive. One of the most overlooked indicators right now is the premium in Asian markets. Silver has consistently traded at significantly higher prices in Shanghai compared to Western exchanges. That premium exists because physical demand is stronger and supply is tighter. It is a signal that the real market, the physical market, is tighter than paper prices suggest. That price gap creates arbitrage opportunities, draining Western inventories as metal flows east. Eventually, either Western prices rise to close the gap, or inventories are exhausted and the pricing mechanism breaks. Both outcomes are extremely bullish. The large institutions understand this. That's why they engage in aggressive liquidity hunts. They're positioning ahead of the inevitable repricing. Every forced sell, every stop triggered, is an opportunity for them to accumulate. So when I see a sharp drop in silver, I don't see failure. I see the sharks feeding. And my goal is simple: be on the same side of the trade as the sharks, not the panicked crowd. Here's the practical takeaway. If you own physical silver, do nothing. Hold it. This is not the time to panic or sell your insurance because of short-term price action. If you are looking to add, be patient and strategic. If you trade futures or mining stocks, respect the key levels. A sustained reclaim of prior resistance suggests the downside move is over. A brief dip into deeper support, followed by a strong bounce, would likely mark the end of this consolidation. For mining stocks, remember leverage. These companies are already highly profitable at current prices. As silver moves higher, their margins expand dramatically. Yet many of these stocks are still priced as if silver were far lower. That disconnect is opportunity. Watch relative strength. If silver dips and miners hold up well, that's a powerful signal that capital is rotating in anticipation of higher prices. Finally, understand the bigger picture. The global financial system is changing. Reserve diversification, geopolitical fragmentation, and de-dollarization trends all favor hard assets. Silver sits at the intersection of monetary metal and critical industrial input. That combination is rare, and it is powerful. What we're seeing now is not the end of the move. It's the setup. The volatility is designed to shake you out. Your job is to stay disciplined, stay patient, and make sure you're positioned as a strong hand, not a weak one. India is already buying Russian oil in rupees. The European Union is actively building digital euro infrastructure designed to function independently of the US dollar. Each of these developments, on its own, chips away at dollar dominance. Taken together, they represent a structural shift in the global monetary system. And history is very clear on one point. When dollar dominance weakens, hard assets strengthen. Gold benefits, commodities benefit. Real tangible assets that cannot be created by central banks at will benefit. But silver in particular stands apart because it occupies a unique position that no other asset can fully replicate. Silver is both an industrial metal and a monetary metal. That dual role is not a theory. It is not a narrative. It is a structural fact embedded in how the global economy actually functions. If you are a country trying to diversify reserves away from the dollar, gold is the obvious first choice. Central banks understand gold. They trust it. But gold has limitations. It is expensive. It is a liquid at scale for industrial use. And it does nothing for a nation's manufacturing base. Silver solves that problem. Silver allows monetary diversification while simultaneously feeding industrial demand. It can be stockpiled as a reserve asset while also being deployed into manufacturing, technology, energy infrastructure, and defense systems. That is what makes silver uniquely positioned in this new world order. It sits at the intersection of geopolitics, de-dollarization, industrial expansion, and monetary transition. And here's the part most people are not thinking about at all. What happens if a major economy decides to remonetize silver, not in theory, not symbolically, functionally? What happens if India, with 1.4 billion people, allows silver to be used broadly in pension accounts and retirement systems, or as bank collateral? What happens if silver becomes an accepted asset for securing business loans, mortgages, or long-term savings? What happens if a Latin American country, such as Mexico or Peru, decides to partially back its currency with silver rather than relying entirely on fiat credibility? The amount of silver required to make those systems function would be absolutely staggering. We are not talking about incremental demand. We are talking about demand that completely dwarfs current industrial consumption. Demand that would overwhelm existing supply chains. Demand that the market, as it exists today, is structurally incapable of meeting. This is not a far-fetched scenario. It is already happening quietly beneath the surface. In March of 2025, India began allowing farmers to use silver directly as collateral for bank loans. That is not speculation. That is not rumor. That is functional remonetization, even if policymakers refuse to use that word publicly. And if that program expands, the implications are enormous. If it moves from agricultural loans to business loans, then to mortgages, then to pension systems, the resulting demand shock would be unlike anything the silver market has ever experienced. The market is completely unprepared for that scale of absorption. That kind of demand cannot be met at $80 silver. It likely cannot be met at $120 either. Prices would have to rise substantially to incentivize enough new mining supply, enough recycling, and enough reallocation from existing stockpiles to satisfy that level of structural demand. This is why short-term price movements are so misleading. When I look at what happened this morning, when silver briefly dropped to 87.80 and retail traders panic sold, I do not see weakness. I see people focused on the wrong time frame. They are staring at 5-minute charts. They are reacting to intraday volatility. They are trading noise. They are not seeing the multi-year bull market. They are not seeing the persistent supply deficits. They are not seeing the monetary transition that is unfolding in real time. They are not seeing the geopolitical realignment that is reshaping global trade, reserves, and settlement systems. They are reacting emotionally instead of understanding the signal, and the signal could not be clearer. Silver is going higher. The fundamentals demand it. The math requires it. The only real question is the path we take to get there. Whether that path includes one more dip to 86.40 or whether the low has already been set at 87.80 is almost irrelevant in the context of where this market is heading. The destination is the same, higher, significantly higher. Anyone who allows themselves to get shaken out by short-term volatility is going to miss what may be the opportunity of a lifetime. This brings me to the most important point in this entire discussion. Trading and investing are not primarily about strategy. They are about psychology. 90% of success in markets comes down to psychology. 10% comes down to strategy. The strategy itself is not complicated. Buy low, sell high. Follow the trend. Manage risk. A child could understand those principles. What separates winners from losers is not intelligence. It is not access to information. It is the ability to execute rationally when emotions are screaming at you to do the exact opposite. When you see silver drop $1.60 in 17 minutes, fear is inevitable. That fear is human. It is biological. But you must train yourself to interrogate that fear rather than obey it. Ask yourself one simple question. Is this fear based on a fundamental change, or is it based on short-term price action? Did anything materially change about silver's supply-demand balance in those 17 minutes? Did industrial demand suddenly disappear? Did multiple new mines suddenly come online? Did central banks suddenly stop accumulating hard assets? Of course not. None of the fundamentals changed. The only thing that changed was price. It changed because large players were hunting stops. That is how markets work. That is not a conspiracy. That is market structure. The rational response is to recognize that this is noise, not signal. This is a temporary shakeout, not a trend reversal. This is an opportunity, not a crisis. But making that rational assessment while your account is bleeding red, while your heart rate spikes, while the voice in your head is telling you to get out before it gets worse, is incredibly difficult. That takes discipline. That takes experience. That takes practice. That is why so many people fail. Not because they lack information, but because they cannot control their reactions when volatility strikes. I'm making this point because I have been there. I have felt that fear. I have sold at the worst possible moment because I allowed emotion to override analysis. And I learned painfully that the only way to survive and thrive in these markets is to develop the psychological strength to do what is right, even when it feels wrong. You buy when others are selling. You hold when others are panicking. You add when others are cutting exposure. That is the edge. That is the alpha. It is not a secret indicator. It is not a proprietary algorithm. It is the ability to see what is actually happening, understand the mechanism behind the move, and position yourself correctly before the crowd catches on. Right now, with silver trading around 88 after a violent intraday shakeout, the right side of this market is long. The right side is bullish. The right side is positioned for higher prices. Could we see 86.40 before we move higher? Possibly. That is a scenario I am fully prepared for. Markets rarely move in straight lines. Volatility is part of the process. But whether that dip happens or not does not change the destination. $100 silver is coming. $120 silver is probable. 150 plus silver is possible if we see the kind of supply crisis or monetary transition that current fundamentals strongly suggest is building beneath the surface. The market handed participants a gift this morning by forcing weak hands out of positions at unfavorable prices. That is how accumulation phases work. That is how wealth transfers from the impatient to the disciplined. The only real question is whether you are psychologically prepared to take advantage of it. Stay disciplined, stay focused. Understand the difference between signal and noise. Remember that you enter where others are exiting. You buy where others place their stops. You accumulate when others are liquidating. That is how this game works. That is how capital moves. And that is how you position yourself to profit from what may become one of the most powerful commodity moves of this decade. The sharks are feeding. Make sure you are swimming with them, not running from them.